I just bought one share of Snapchat while filming this intro. Took me a minute and I spent less than you think I did. I'm going to show you the way I do it. Trust me, you can buy your first stocks today. You just don't know it yet, but you will, because I will show you how to do it. I'll explain how the market works, and I will share my method for buying pieces of great companies at a discount. Now, don't get me wrong, I'm not saying it will be easy, but it will be simple. Now, before we start, please do me a favor, like this video and subscribe to my channel. Thank you. Time is money, let's go. Your first objective is called taking the first step. Now, taking the first step means stop overcomplicating things and start doing. In this case, you want to be an investor. Well, guess what? Start investing? Maybe? Possibly? I'll show you how simple it is. Here are 3 of my favorite trading platforms that I use on a daily basis. Tell you something right now. If I'm feeling like a proud American, buying only American stocks, I will use Robinhood. And here I buy stocks without paying any commission. Just pick a stock you like, hit buy. It's that simple. Now, for more global stock trading, I use eToro. And here it's the same. Don't use leverage and you get a commission-free stock. Few taps, super simple, super easy, the stock is yours. And sometimes, when I feel like representing the UK, I'll use Revolut for zero commission trading. Each platform has their advantage, so hit pause and check out this quick summary I made with the key details.
A few moments later.
I use all of these platforms, but that's just me. And don't worry that you have no idea what I'm doing. Maybe it will get a bit confusing at some points, but we'll get there. Trust me, by the end of this video, you will understand how to do this. But the key here is to start. Risk a small amount of money that you probably won't even notice and buy your first company. This could be any company you like and buy today. Voila, you're an investor. I believe 99% of you have enough money to do this. If you don't, just think about it. Do you need to eat out every day? Or you could maybe start packing your lunch at home and buy a share of Beyond Meat. Do you need to spend $60 on a new video game when you could buy 2 high dividend yield AT&T stocks for the same price? Or do you really need the latest Nike sneakers? Street credit's important, but not as important as money in your pocket. So why not buy Nike stock instead? Shift your mentality from a consumer to an investor and make a habit of investing a small amount of money in the companies that you like. This is what taking the first step is all about. Now it's time to read the charts. Bit of background on how stock trading works. There are only 2 ways to make money in the stock market. You buy a small piece of a company, also known as a share or a stock, from a broker. The company grows, makes money, and this share becomes more valuable. You buy it for a lower price, sell it for a higher price. You profit the difference. Now, the other way is if you pick, let's say, a stock that's not going to do so well. Selling the company if you think the value will decline. Now, this is a bit more complicated and I won't even talk about it because, frankly, you will not be doing this as a beginner. We will focus more on long-term stock investing. It's safer and it's a great start to further knowledge. The chart represents how the price of a stock or any instrument for that matter, has moved across time. You can look at the bar chart, the line chart, and other types, but the most popular and the one that we're going to be using is the candlestick chart. Each candlestick indicates the open price, the high of the session, the low of the session, and the closing price for the time frame we have chosen. For example, if you look at a 30-minute chart, a new candlestick will be drawn, you guessed it, every 30 minutes. The weekly chart, a new candlestick every week. The 1-hour chart, a new candlestick every hour. You get the idea. With our long-term investing goals, you will be looking at the weekly and the monthly chart. And I just lied to you. We're going to also use the daily chart, but we'll get to that. And there are 2 key things that we can look for when studying the charts with a long-term goal. The first one is determining the trend, whether the price is going up or down. Now, obviously, if you look at any candlestick chart, we can see this from the trajectory, whether the candlesticks are going up or down. But the real way to establish an uptrend is if the candlesticks have higher highs and higher lows. If it's downtrend, it's going to be the opposite, lower highs and lower lows. And remember, You cannot determine the trend by looking at the short-term charts. The minimum I would use is the weekly chart, because what may look like an uptrend on the hourly chart is actually a strong downtrend when looking at the bigger picture. Now, a couple more things we can see on the chart. If the price is consolidating, the candlesticks will gather in the same area, around the same price level. This signifies indecision around the stock, meaning that both buying and selling pressure are equally strong, and normally I would not open a long-term position in a period of indecision, unless it's about to break out the support or resistance zone. What are these zones? I know a guy, he can explain it to you.
Hello everybody, glad to be back on the show. Today I've been tasked with explaining the support and resistance zones to you. Now, we have the Netflix chart here, of course. Netflix, we all love Netflix. The daily chart, each candlestick is 1 day on the trading chart. Now, what is the support level? The support level is an area on the price chart where the prices have struggled to break below. So it looks like this. As you can see, this is a clear support area. Another one is right here. Now, how do we determine these levels? We need a minimum of 3 touches over a period of time to this area. The price needs to struggle to break below this level a minimum of 3 times. So one here, and one here. And here it's even more. One here, one here, one here, here. All these candlesticks have struggled to break below this level. Now, once we have a minimum of 3 touches, then we can consider this as a support zone. Now, why am I saying zone? Because some of these candlesticks are going through the level, as you can see. Also here. Now, that tells us that it's not a solid level. It's not a solid line. It's more like an area. And as you can see, it's best to think of it as a sort of a channel where the price is struggling to break below. So all this we would consider the support zone over here as well. Now, the resistance area is a level on the price chart where the prices have struggled to break above. Quite the opposite. Now, clearly we have one here, a minimum of 3 touches, 1, 2, and 3. The price is struggling to break above this level. The selling pressure is too high, and when the price hits this level, it reverses. Hits this level and reverses. Hits this level and reverses, most likely. Now, and again, this is more of an area. But remember, the most important thing to remember here is that we need a minimum of 3 touches to determine the area or the level. Now, another really cool thing is that when resistance gets broken, it usually becomes a support level in the future. So, as we can see, we can clearly identify another resistance level here, resistance area. Minimum of 3 touches, 1, 2, 3. 3 touches, we can determine that the price is resisted at this level. Now, but what actually happens when the price breaks the resistance level? It breaks up, shoots higher, and then the old resistance zone becomes the new support zone over here. And this is clearly evident. As you can see, this is now the new support zone after the resistance is broken here. New support zone, and what this actually tells us is that the price is more likely to bounce off of this level in the future, bouncing off the support level. So a broken resistance does become a support zone in the future. But why is this important? Let's just delete all of this and I will explain. That is because we can use these levels to advantage when opening trades. What do I mean by that? There are 2 key positions that you can use when buying stocks. The first one is when the resistance level gets broken. This one here is a major buying opportunity. As you can see, the price managed to go up higher. The second major buying opportunity is when the price hits the support level. When it hits, it will most likely bounce higher. When it hits, it will most likely bounce higher. This is where we can enter the trades here, 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 and actually right now. Perfect buying positions. because the price is most likely going to reverse higher. Always, of course, I'll always remember to use the stop loss and the take profit in case that the candlesticks actually reverse lower. This is the basics of the support and resistance zone.
Believe it or not, knowing how to determine the trend and identifying the key areas of support and resistance is perfectly sufficient chart knowledge to open a long-term investment in a stock. Just in case you are looking for the best short-term patterns, we've compiled them on our website, so you can check them out too. Now we're going to be doing stock picking, basically picking which stocks to buy to make us the most amount of profit. Now, how do we actually know which stocks will make us money? I'll tell you something right now. We don't. And I'm 100% serious. Even though it's impossible to predict the price with perfect accuracy, we can get pretty darn close by predicting the most likely scenario. And your next favorite hobby is how you're going to do it. Of course, I'm talking about research and analysis. Specifically, fundamental analysis for long-term investing. Did you know that what we see and read in the news is actually not the real value of a stock? It's more like the most popular opinion of what the value is. It's based on hype, news, 1,000 other things. But studying the company's fundamentals is really the only way we can find out the real intrinsic value, whether the stock is overvalued, undervalued, and whether or not it's a good long-term investment. And there are two ways to do this. The easy way is just go to investing.com or Yahoo Finance or any of these websites and see what the analysts believe is the most likely scenario. The way I do it is to study the balance sheet, determine if the company is growing and is it actually making money, and then finding the intrinsic value and the perfect entry point. And that's exactly what you're going to be doing. And I'm going to share my method in 3 steps. Step number 1, before buying a stock. Now, the way I find companies is I look for companies based on what I'm interested in. So I like shoes. Yeah, I like Nikes. Nike stock. I like using Snapchat. I like Teslas. Tesla. You get the idea. Just don't go searching for the perfect magic company. Just look around you, think about your life, think about the products that you're using, and start there. Then evaluate the business as if you want to be the owner. I know it's hard to get this in your head, but you just have to think of it as your business that you understand. So the question is, what does the balance sheet of my company look like? And to find this, I use the service called Morningstar.com. Remember guys that I'm not a licensed financial advisor, so I cannot tell you what stocks to buy. I can only tell you what I look for. And I'm looking for consistent growth. That means increasing sales, earnings, and cash flow from operations. Let's look at Microsoft. I've invested in this company. I like it. I use Windows. You get the idea. First, does it make money? So if you look at the income statement in the financials section, we can see that revenue has been increasing consistently over the last 3 years. And so has the income, the net income. So 110 billion in 2018, 125 billion in 2019, and 147 billion in the last 12 months. You see the trend has been going up. Next up, we can see that the debt to assets ratio has also been positive. Microsoft has consistently lowered their debt while increasing their assets. If you look at the debt here, that's 81 billion in 2018, 78 billion in 2019, and 71 billion in 2020. The assets has been increasing by 258 billion in 2018, 286 billion in 2019, and 301 billion in the last quarter. As we can also see, the trend has been going up, and the trend for the debt has been going down. And finally, cash flow from operations. It's basically how much money the company brings in from its normal operating activities. For Microsoft, this is obviously software, Windows operating system, Microsoft devices, and so on. And here we can also see consistent growth over the last 3 years. So that's 43 billion in 2018, 52 billion in 2019, and 66 billion in the last 12 months. The business is growing, it's making money, very good. Next up, we can see that based on the fundamentals, the stock is actually trading at fair value. And this is important for long-term investing because we want to buy companies that are trading at a discount. So we can see here that it is trading at fair value and it also has a wide, stable economic moat. That basically means that it has a competitive advantage in business over its rivals. Now, if we just click on competitors, we can see that, for example, Apple has a narrow economic moat. And for example, Apple is also trading at 28% premium compared to its fair value, which is only $85. Now, this makes Microsoft a a very attractive company, and I would certainly add it to my watch list. Immediately we can see that the company has been growing for the past 3 years, both in revenue and net income. Net income is what's left in the company after all the expenses. And here it's stated in billions. But what next? Do I just go ahead and buy the stock? Well, not yet. This is where I grab a piece of paper and write down my investment proposal. By the way, I already have one here, but anyways, I'm going to show you the process. So, let's find a page that's empty, because I have tons of these here. Okay, first, what does my company do? How does my company make money? What are some of the major risks my company is facing at the moment? Simple. When I'm done with that, I write down 3 to 5 reasons why I think this stock is a good investment right now. For example, if I'm interested in Microsoft, obviously the first thing would be Microsoft just won the JEDI contract over Amazon. Number 2 would be the stock is actually fairly valued. Number 3 would be working from home has boosted their sales significantly. And as we know, Windows PCs are more accessible than Apple for the average consumer. And this could also be some setback for the company, because if it's a great business and it's hit by some short-term problems, it's a tremendous opportunity to buy low and sell high. Step number 2, after developing my investment thesis for a stock that I want to own, it's important to buy it at the right time. And this is where we can sort of integrate the technical chart analysis into our fundamental long-term goals. But not the complicated version. Remember, trends, support and resistance levels. It's that simple. And there are 2 rules I follow no matter what. Rule number 1, I never buy stocks on a downtrend. What's low can go even lower. It's one of those stock market things that you simply don't want to test for yourself. I've been there. And number 2, I always try to buy stocks that are trading on the lower edge of the historical value. Now what that means is I'm waiting for a dip or a pullback in an uptrend. So if you look at the chart for Microsoft, let's take the weekly chart, trend is going up, the price is making higher highs and higher lows. A dip would be a retreat from the overall trend. So I see a clear buying opportunity here, for example here, 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 and actually right now. I'm waiting for the price to correct lower and then making my move. Also, if you go to the daily chart, this is where you can find precise support and resistance levels for an even better entry. So if the price, for example, made a solid push through resistance, I would most likely buy the stock. Okay, lastly, step 3. What do I do when I've bought the stock? Some traders say that if you've done your research properly, you can pretty much buy and forget about it. But I'm not sure I agree with it. Personally, I get up earlier a couple of times a week and spend the first morning hour reading up any official statements, news, data from my companies. And also, super important, I like to pay close attention to any upcoming earnings dates. Then at the end of each month, I revisit the small essay I wrote about my company. Are the 3 to 5 reasons still valid? Are the 3 to 5 reasons why I'm investing still relevant? Is my company still on the right path? You get the idea. If it's a match, then I can consider reinvesting some more money into my company, or perhaps take some cash out to lock in my profits. But I would never sell all of it, just sticking to small profit taking. Because if my company is still making money, I still believe in it, there's no reason to close the position altogether. And it's also important to have a plan when things don't go according to the plan. No pun intended. But here it's important to understand the reasons behind the price falling. For example, if the overall market went down, I would consider buying some more at lower price instead of selling it all off. Remember, short-term problems, great buying opportunities. And this is why checking those reasons why you bought so important, because I would only sell if one of those reasons changed. For example, one of my reasons for buying Tesla, which is actually a hugely overvalued stock by now, not back when I bought it. One of my reasons for buying it is my belief that the next 20 years will be absolutely game-changing for renewable companies, renewable energy companies. So if, for example, Elon Musk suddenly announced Tesla is shifting to diesel-powered cars, my reasoning would be broken and there would be no reason to hold on to the stock. Of course, he will never do that. It's a crazy example, but it's just to illustrate my thought process. You need to prepare your arguments, this will massively increase your success rate. And it's a good start to building your portfolio. And if we're talking about portfolios, next chapter. An investment portfolio is essentially like a basket of shares that you are trading with. If you own shares of Microsoft, you're a shareholder. But the moment you start owning more shares, for example, Microsoft, Apple, Amazon, you're building a portfolio. In this case, you've built a portfolio of investments in tech companies. But careful when you do that, because a good portfolio comes down to good diversification. And in order to achieve good diversification, you need to figure out how you want to invest. Whether you want to invest actively or passively. You see, a passive portfolio will be more diversified to track the overall market and grow bit by bit over time. If you want to be a passive investor, the easy way, listen to this guy's advice.
Buy an S&P 500 low-cost index fund.
The grandpa is correct. He's actually been correct for the past, who knows how many years, 100 years. Buying ETFs is easiest and fastest way to achieve diversification because it's sort of built into them. An ETF is like splitting $100 and putting $1 into each company. And the companies vary in the sector, the industry, and etc. So it's very diversified. And plus, if you own more than, let's say, 15 stocks, it's almost a full-time job to keep up with what is happening to each and every company. If you have enough money, you can just go ahead and invest in a stable ETF, which will bring around, I think, around 7 to 8% return every year. I think on eToro, and I don't think, I know for sure, on eToro you can buy ETFs for as low as $200. It's like a fractional ETF. Instead of paying like the full $300 or something dollars for what Mr. Buffett mentioned, you can get it for $200. And any percentage gain for the ETF will be reflected with your $200 investment. Pretty simple. Now, if you have even more money, you can just go ahead and buy a stock market index. Stock market index sort of sums up the value of all the companies in the index and provides a numerical benchmark for the economy. That's why you always hear in the Bloomberg news, Dow Jones is down this, S&P 500 is up 5%. These are big events in the market because they reflect the overall economy. I don't know if you know this, but 2 years ago, Tesla stock fell 9% after Elon Musk smoked weed on the Joe Rogan's podcast.
I mean, it's legal, right?
It's totally legal.
Okay.
How does that work? Do people get upset at you if you do certain things? There's tobacco and marijuana in there. That's all it is.
Now, is that something that you as a stockholder could have predicted in your analysis? It's pretty hard if you ask me. I certainly wouldn't. But as always, there are two sides to the coin, which is why when Spotify bought the same Joe Rogan's podcast for $100 million a few months ago, their stock went up 8%. This is a great example because it shows you that stocks are more susceptible to larger swings due to a lot more variables. The price can fall, but you can regain as much and even more very quickly. While an 8% swing can still happen when trading indices, usually they're smaller in scale and reflect the overall economy, which is frankly easier to monitor than dozens of variables for a single company. And the advantage to buying stocks, which is what we're going to do with active portfolio, is that they almost always outperform the index in terms of returns. For example, you can see that Apple has outperformed the S&P 500 index by about 80% in the last 12 months. Now, the only way to outperform the indexes or ETFs is to understand the business behind the stock that you're buying, which we covered in the previous chapter, and then spreading your investing money logically between the investments. So if it's a risky stock, high uncertainty stock, I won't invest as much as I would in a stable blue chip stock. So risky stocks, smaller investment, safer stocks, bigger investment. Now Morningstar shows that the uncertainty for Microsoft is medium. And since the stock is actually trading at fair value, I would feel pretty confident investing more rather than less in the company. How much? Well, ultimately that will depend on you. But generally, I don't want to invest more than 10% of my money in a single company. So if my company's proposal, my investment proposal looks really good, and I believe this company will do really well 3 to 5 years down the line, maybe, possibly, I would invest 10%. And as you can see, this limits my portfolio to just 10 companies that I really believe in, and I really believe they will outperform the indexes. And also, if I have invested 10% in a tech company, I'll most likely invest a smaller amount if I want to buy another tech company. So I don't want to be concentrated too much into one sector. There are only so many companies you can actively keep track of. Once you start adding more and more, it takes up more and more time to study them. This is why you want to limit the companies you are studying to the best ones that you believe. Fair value or undervalued, solid history of growth, signs of progress in the future, and company that you actually like. This is important. Now, there is actually a way to test how your portfolio performs without risking anything. I want you guys to go to the App Store or Google Play Store and download the Trading Game. This is a real-time market simulator that tracks the real markets. It lets you trade just like you would on eToro or Robinhood or any other broker, except you don't risk anything. So once you're done researching your company, you can then add it to your portfolio in the Trading Game. Trade with it and see how accurate is your most likely scenario. After that, if you're ready, it's time for the real thing. But you should be by now, because I told you, buy your first stock today. Now, before we get to the platforms, I want to tell you a fun fact. If you start investing $100 each month, this will give you an investment of $1,200 per year. Let's just assume you have an annual return of 10% of your investment, which is not unrealistic at all. Remember, Apple outperformed the market by 80% this last year. Now, 10% return, $100 investing each month. Over the next 20 years, you will have invested $24,000 and earned $52,000 in interest, with a total balance of $72,000. But what if, instead of taking that money out to buy yourself a new car or go on a vacation or party with your friends, you leave it for another 20 years? Same $100 per month deposit, same 10% return. Over 40 years, you will have deposited $48,000, double the amount, but you will have earned $590,000 in return. This is the beauty of compounding. It's like a snowball effect. It's like cut out Netflix, cut out video games, cut out junk food, and buy stocks instead with that money. And you're rich. You just don't know it yet. Now, to maximize the compound interest and save even more money, it's actually crucial to invest with a platform that offers little to no fees. Let me share these 4 reliable platforms that offer zero commission stock trading. That means when you buy a stock, there will be no hidden fees, no transaction costs, and things along those lines. If you buy a stock for $100, you own a stock valued at $100. The first one is eToro. Zero commissions when buying stocks without leverage, aka investing. I use this app, I love it. I use the platform, I've used it for many years. If you've been following this channel, you probably know. But the great thing about eToro is that they offer a huge selection of worldwide stocks and ETFs. And they also offer the option to buy a fraction of the share instead of the full thing. So if you want to buy a Tesla stock that costs like $400, you can buy it for $50. Pretty simple. And zero commissions when buying stocks. We've made a video about it. Feel free to check it out. You will get the key details there. The second one is Webull. For now, this app is for Americans only, but they plan to introduce their services in Europe. Suppose you're not from the United States, you can still download the app, and because it has some really cool features for stock analysis and things along those lines. Very useful. I didn't mention it before because I'm not frankly using it. I use Robinhood instead, but it's a really good offer. And we also made a video about it, so make sure to check that out as well. And finally, we have the Robinhood. Zero commissions for trading US stocks and ETFs, and a very simple bare bones platform. Sort of similar to eToro, and basically as a beginner, you need a simple platform to make your trading successful, because learning a program while learning trading, it's a big no-no. Now, in my opinion, the only drawback for Robinhood is that the stocks and the ETFs are limited to US markets only, so you won't be able to diversify your investments worldwide. But the advantage for newcomers, again, fractional shares and zero commissions. Very cheap, very cool, very simple. If you want to find out more about Robinhood, let us know in the comments and we can make a video about Robinhood as well. And of course, the last one I mentioned earlier is Revolut. It's a UK-based company. It's sort of works like PayPal. You can send money, receive money, things along those lines. But of course, we're looking for the option to buy stocks, and they offer it. You can buy fractional shares for very cheap. Definitely check it out. I've been using it for the past couple of months. I'm starting to love it. Pretty simple. I truly believe these 4 platforms are your best choices in the beginning, depending on your individual needs. So start saving, buy your first stocks, think like an investor and do careful analysis of the companies that you like. And choose the right platform depending on your individual needs. By now, you should have some basic tools and understanding to get you started with stock investing. Of course, we can only cover so much in a short video before you guys start to fall asleep. So some things were left out on purpose. If you want to learn something more about a specific topic I covered, please leave a comment down below and I can make a video about it. Of course, the obligatory, if you didn't do it earlier, please like and subscribe to my channel. It really helps me a lot. And as always guys, thank you for watching. Best of luck in your investing journey and see you in 40 years when you've made $500,000. Just joking. See you guys very soon. I'm off to do some stock analysis. Bye bye.